In this video we're going to be looking at some other supply side factors. So first of all we're going to look at how government assistance to industries can impact aggregate supply and how governments enforcing certain types of regulation are going to impact aggregate supply. So here are some other supply side factors. This video we're going to focus on the next two, and the next video we'll focus on just how participation rates, industrial disputes and climatic or geopolitical events can impact aggregate supply. So government assistance can come in the form of subsidies, so providing cash payments to producers or consumers, and the same with rebates or grants for people to invest in certain areas. It can also include tax concessions, which is like reducing the amount of tax businesses have to pay, or tariffs to try and protect them from imports. So first of all, subsidies and rebates, money paid to households or businesses designed to reallocate resources towards areas of nation's best interest. So often they'll be to do with positive externalities, to try and promote positive externalities. Also common in the farming industry to try and protect our local farmers so agriculture doesn't move offshore. So you've got to be able to distinguish between a consumption subsidy or a rebate, which is like money paid to a consumer for doing a certain thing, and a producer subsidy. So with production subsidies and rebates, it basically reduces the price of items because consumers receive the subsidy. So in the past, consumers might have received a subsidy from installing solar energy or getting a water tank, or they also gave the grants or the rebates where they gave $1,000 to every consumer. The idea of consumption subsidies is to try and boost consumption spending. It lowers the prices of certain goods and services in some instances, or gives consumers more access to money, and therefore that will allow the demand curve to shift to the right and lead to an increase in aggregate demand. So consumption subsidies are more of an aggregate demand side policy to try and boost consumption within the economy. Production subsidies can impact both aggregate demand and aggregate supply. So the good thing about production subsidies is that they reduce businesses' costs of production, and they're often used as an incentive for businesses to invest. So for example, in 2009 there was the payment to the schools for the buildings. They gave most schools sort of upwards of around sort of $500,000 in some instances to expand on their infrastructure, improve the quality of their education. And while it wasn't the best thought out plan, the idea of that was to try and boost investment expenditure within the economy. And they also gave subsidies for a lot of companies for wind farms and solar panels. So basically they gave firms money to try and invest in renewable energy. And the idea of that was to try and promote investment within those industries. And that will have a positive impact on aggregate demand. It'll also help boost productive capacity in the long term, which should help to reduce inflation and again lead to an expansion in aggregate demand. Production subsidies can also affect aggregate supply. Okay, the idea of these subsidies, so if we were, for example, to give a subsidy to our car manufacturers, the idea of that would be to lower production costs, increase profitability, and therefore make them more able to and willing to supply at any given price. So in the past they've given subsidies to producers to provide public transport, which lowers the price of public transport, education, school grants to build infrastructure. All of these are things that will eventually boost aggregate supply. So these school grants, as you can see, are more a demand and a supply side factor, but most subsidies, the idea is to lower production costs, increase profitability, and increase our international competitiveness. Tax concessions are a little bit different. Tax concessions are a form of government assistance whereby the government provides tax-paying entities the ability to reduce their assessable income and tax liability. So what I mean by that is, basically, if they do a certain thing, that might allow them to claim that on tax and reduce the amount of tax they have to pay for the government. So a good example of that would be 150% research and development tax concessions. So what that means is that if a business was to, say, spend $1 million on research and development, okay, rather than that would reduce their profits by $1 million. So they'd be able, that would effectively mean that they have to pay $300,000 less tax because their profits will be down but $1 million. Allowing them to claim 150% tax deduction basically means that rather than claiming at 30% of that $1 million, they can claim 45% of that $1 million. So essentially what happens is that they can claim, of that $1 million, they're claiming $450,000 back in tax, and therefore they don't have to pay as much tax on their profits. So the idea of tax concessions is to lower businesses' assessable income that they have to pay, and therefore they end up paying less tax to the government. They also did the same thing with depreciation allowances. What that basically was is if you brought anything that was worth less than $20,000, what they did is they basically allowed businesses to depreciate it straight away so that they could claim it all back on tax basically in that first year, and it was an incentive to purchase new assets. So if I went out and purchased a $20,000 machine for my business, I'd be able to basically claim $6,000 back in tax that year by depreciating the whole thing, and therefore effectively it's only costing me $14,000. We'll discuss depreciation allowances a little bit more in class, but it's another way to reduce businesses' tax. On the demand side, tax concessions encourage investment into new products. So they encourage investment into infrastructure because it will reduce your tax liability. It encourages businesses to purchase new products in the case of the depreciation allowances. So it would boost investment expenditure. On the supply side, it helps to lower costs of production, lowers their production costs, and encourages supply and boosts our productive capacity as well. I'm going to leave it there and talk about government regulations in the next video.